Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Thursday, August 27th. Today on the show, the Information has exclusive reporting that Nvidia is acquiring open source AI platform Hugging Face for $12.9 billion. We'll talk to the Information's deals reporter who broke that story. We'll then unpack NVIDIA's quarterly results. Revenue more than doubled. We'll talk about that with an analyst. And we're going to close out the show with Salesforce's quarterly results. Investors seem to like them, and its big expanded partnership with Anthropic. Does this mean that the SaaS apocalypse is over? It's going to be a great show. We're going to find out the answer to that question very shortly. Let's get right on into it. Nvidia is continuing its deal-making streak. The Information exclusively reported last night that the company has agreed to buy Hugging Face for $12.9 billion. My colleagues Amir Afradi, Valida Pau, and Phoebe Liu wrote that story. I want to bring on Valida to share more about what she knows. Valida, welcome back to the show. It's great to have you here.
Oh, great to be on.
So was Nvidia always in the mix for Hugging Face here, or is this a surprise to us?
I feel like it started with an unsolicited bid, according to our reportings, and then deals talks have happened throughout between Hugging Face and Nvidia happened throughout that time. But it makes a lot of sense for Nvidia to kind of be in charge of a strategic asset that's that hosts a wide range of open source models that developers can use. Nvidia has been kind of really pushing aggressively for its own open source models, and Jensen Huang, Nvidia CEOs, believes that having successful open source models will kind of preserve NVIDIA's kind of dominance as these models can run on NVIDIA chips.
Who else was in the mix? Do we know in the bidding process?
Um, Hugging Face counts a lot of kind of strategic investors there already. So we do know that Salesforce is one of the potential bidders, and our sources have said lots of the big hyperscalers are among the parties that are interested. But
Right.
towards the end, Nvidia won.
Well, they can pay a lot more than anybody else too, I imagine, so that certainly helps. I wanna ask you about the multiple here. I mean, you reported that Hugging Face is generating $150 million in revenue right now, which would put it at about 80 times revenue, the multiple. I mean, is this just a reflection of how in demand open weight models are right now?
I feel for an 80 times forward revenue is a pretty expensive deal, but I felt for Nvidia, the multiples here doesn't matter because it's a very strategic move for them, and Hugging Face kind of for their open source kind of approach from the very beginning, and then they are wide distributors of all these open source models that developer can use. Their customer pay a monthly subscription fees, and and pay how much computing powers they're using. So for Nvidia, this can allow them to get access a wide distributors of these open source networks that will ultimately benefit them. But Hugging Face has been growing faster in recent months because these exploding interest in cheaper open source models that others have been using to cut costs from closed source models from Anthropic or OpenAI. So they have been growing faster in
Right.
recently.
So I mean, you've been watching and scooping much of the Nvidia deals chatter as of late. We had the poolside licensing deal, I think, a couple weeks ago. We had the investment in Perplexity that I believe you reported, and now there's this. Are you expecting Nvidia's deals to continue here? Do you think it has enough? What are people in your deals orbit thinking about this?
Well, this is a series of deals that NVIDIA has done just in August. So they have put in lots of investments in kind of these land and power firms that help develop AI data centers. That includes Lancium, SB Energies, and of course that $100 billion backstopping deal for OpenAI um, data centers. They also invest in data labeling startup Mercor, do the licensing deal with Poolside, and also discussing investing in Perplexity. So it seems Jensen Huang is on like a deal making spree here, and we don't feel like he's gonna stop as he kind of like build out his vision for like his empire, like and it relies on or like now increasingly more important for like his open source ambitions.
Right,
So
right, and then the other area that I'm personally watching, and we did have a company, Emerald AI, on the show earlier this week. They are a data center energy
yeah.
optimization company. Nvidia has invested in them. I mean, that sort of goes along with the thesis that Nvidia, the next gap they might be looking to acquire companies in or maybe invest in is the energy sector. And so that's an area that I feel like they could be making more headway in the weeks to come.
Oh, they could be. I feel like they have done lots of kind of like acqui-hires in the past for their own teams. They can also still kind of do more on chip sides and of course, like, on their AI efforts.
Right. I want to talk about another story that you scooped yesterday. So you and our colleagues Rocket and Amir wrote that SoftBank is looking to take a majority stake in a humanoid robot company, 1X. Tell us about what we know about this chatter.
So, SoftBank is talking about buying a majority stake in 1X, which is a humanoid robot makers. What is interesting is that 1X previously had talks with kind of like OpenAI last year about like a possible takeover, but like that deal didn't pan out. So like this is interesting in a way that like SoftBank's major shareholders is kind of like discussing a majority stakes in this company that OpenAI has backed and had M&A talks in. But broadly speaking, this fits into like, SoftBank CEO Masa's grand ambitions in like, physical AI is going to be the next frontier, like the future of SoftBank. And he has been kind of like assembling, pieces of like, different robotic startups and investments to kind of like, build out this vision of him that like, believes that, robots and like physical AI will be like the next frontier of the AI development and and a breakthrough in technology.
How does the $6 billion valuation compare to past valuations that 1X has had?
So last year, OneX had to raise 1 billion and a $10 billion valuations, but they never really raised the full amount. Our sources tells us that it's like less than half the target. So in a way that this is a down round, but in January 2025, they're only like valued in under 1 billion. So it's still a huge step up for like a company that's really not ship many robots or their products, and like they're not generating lots of revenue. So it's still like a steep price to pay.
How far is 1X along in its own humanoid development right now? I've seen some of their models on their web. I mean, they seem to have some prototypes. I mean, do they have something that they're selling right now? How far are they along?
I think they have, like, started pre-orders for, like, their robots, and, like, they have promised or, like, told customer they're gonna, like, ship it by the end of 2026. So, we'll see if they can, like, make that timeline, and we'll if customer have the robots in the homes.
And I mean, Valida, just to take a step back here, given that you spend your day talking to everybody in the deal's orbit, I mean, Jessica had a great column this week talking about the deal landscape broadly, why she expects it to continue and in some cases even pick up. I mean, from your view, why have deals picked up so much this summer? It seems like it's not just Nvidia. I mean, these acquisitions are fast and furious. What has changed in the last couple months?
I feel like tech deals has been sort of slow for the, like, past year, and now, like, suddenly there's, like, all these rage about, like, big price being paid to AI startups. I felt like, still fundamentally, tech companies believes in, like, AI is worth investing in, like, they still need, like, great teams to help them kind of achieve that. And there's, like, so many companies, for example, like, there's so many, like, maybe not older, like, maybe older, like, after 2022 startups that, they may not be able to take off, they could find homes, like, in these strategic players and, like, these particularly high in demand startups, it's become more and more important. So, like, tech companies feel like they need to make the jump here. But of course, like, these days, like, those people talk about, like, CapEx is new M&A. So maybe, like, as tech companies spent so much on CapEx, like, early this year, they, like, slowed down the deal machines, but, like, they could start back up again.
Right. Well, Valida, I want to thank you for coming on. That is Valida Pau, our deals reporter here at The Information. Okay, speaking of Nvidia, shares are up today after the company once again managed to lift investor expectations. Revenue more than doubled, although free cash flow fell over 50% because of payment terms from customers. I want to bring on Ray Wang, CEO of Constellation Research, for his thoughts on all of this. Ray, welcome back to the show. It's great to have you here.
Hey, thanks for having me here. And I'm actually here in New York. Look at this.
There you go. Well, we like the East Coast here, as we do. What stood out to you from the results?
Look, 23 out of 25 beats, 6 quarters in a row. What was really standing out was not the results. We all expected good numbers. It was the guidance. 70% revenue growth, Colette said, versus 45, 46% was the expectation. I think that was the reinsurance that this AI fueled stock market needed.
Even with the supply constraints, 70%. So, I mean, this was kind of interesting that they're still seeing constraints.
We are so fickle in this market. We're like, there's not enough demand. This is all fake. What the heck's going on? Then we're like, oh my God, 700 billion this year, 1.2 trillion like next year, 1.5 trillion the year after that. Okay, do we have enough supply? I mean, that's some people are like, oh, great, we got to worry about supply now. You know
Right.
what? They'll figure it out. I mean, we're seeing the capacity, they're investing in the plants, they're doing the AI factories. But I think what's interesting is the way NVIDIA is layering their future revenue. You can see it by the investments they make with the startups. You can see it with the investments. I mean, in the last 4 weeks in the Valley, I cannot tell you how many people I know that were going to visit NVIDIA to get a Nemotron partnership in place, right? And that's the open weight models that they're pushing, and they're going into that space pretty quickly. So you can see that not along with the investments, the AI factories, along with the fact that chips are now a asset class on its own. I mean, all these things they're doing is designed to continue to further that demand and make sure that there are no surprises in the market.
Right. I want to get to their broader investment strategy here in a minute, but I mean, if we just stick with the results, so the day sales outstanding was interesting. I mean, they seem to have looser payment terms here for some of their biggest customers. 45 days to 60 days. I mean, our executive editor Martin Pierce made the point last night in his briefing column. Uh, what you need 15 more days to pay off billions of dollars in these contracts. I'm not sure what difference it actually makes. I mean, are we missing some context here on the ground? What's your understanding of why this is coming together?
I don't know. Maybe someone's making money on the float. No, I was kidding. That's a lot of float. I mean, I don't know. I think it's probably they may have changed the way that they're billing. I don't know for the ground in particular, but I do know that people were focusing in on that number, trying to understand. Is there a shift in terms? I would say that probably the biggest shift we're seeing right now is just how people consume and what kind of outcomes. And there might be some promotions and other MDF that's built in there that we might not have seen, but to me, that wasn't necessarily a red flag. I think for me, what I was really interested was just looking at, gross margins coming down. That was a great to set that expectation. I think it was also important to see that, even with the adjusted gross margin, these forecasts were kind of like on the big side. I mean, data center was at 43.5 billion, and that's going to get to, you can see that getting to 50 to 60. Industrial was at 41.7 billion. So in our models, I mean, we're seeing something we're seeing like this is real, and now we're worried about supply chain costs being passed on, and so the rate increases. That's the one that we're going to look at to see how much more it's going to be to buy something on Rubin, or how much it's going to be when we get the frame in. So I think the next set of chips that are in the
Yeah.
product road.
What about the 25% of revenue coming from the AI Frontier Labs? Was that higher or lower than you were expecting?
It's actually in line. We're going to see the AI labs continue to get better in terms of token usage, and they're going to need more capacity. So we're
Yeah,
trying to
but
figure out what
it's not a concerning amount to you, 25% from the labs.
I would be concerned if that was 40%,
Right,
50%, because we're hoping
right,
for diversification, right? We want it to go to physical AI. We want it to go to sovereign AI. We want it to get into CUDA and software over time. That's going to be important.
right. Now, the other number that was interesting to me was they talked about sort of the per gigawatt revenue opportunity and that getting to $40 billion per gigawatt, I believe it was, for the Rubin family of chips. Just help us unpack what that means. I mean, is that just pricing power from NVIDIA raising prices, or with a premium product here? Is there other stuff baked into that?
I think the best way to think about it is like you're buying chips. You're willing to pay for more for chips if they're actually able to get to some level of scale. Is it faster? Is it better? Is it cheaper? Am I consuming more energy? Am I consuming less energy? Am I getting more MIPS and I'm getting more processing per unit? That's what people are looking for. And I think NVIDIA's built out these curves over time. They're starting to introduce that terminology so people understand that, hey, it's okay if you're 2 generations behind because you buy the latest version of our chips, it pays for itself.
So help me understand. So is it just that the Vera chips are more expensive, or is this
I can crank more out on the Vera chips than I can on the other chips. I'm going to crank more out on the Feynman chips. Is that 10x? It might be like 3x, 4x. I mean, that's what they're looking at.
okay? And so in other words, is that saying that even for the older family of chips, I mean, we should expect that per gigawatt figure to go up in the future as well, or how should we track that?
You expect that the performance is definitely going to go up. And if that gigawatt has a correlation, right? Remember, we're also going to have a used chip market as well. And so the question is, how do I value my used chips in my used data centers versus what's in the new data center? And I think we're just going to be able to start seeing those comparisons against performance.
Got it. Got it. Got it. Um, Jalapeno, OpenAI's chip. We saw some results from that, or well, we heard from OpenAI their results on that. Do you think it is a threat to maybe not Nvidia, but to its competitors in this market?
Everyone's going to build custom silicon, and that's really important, right? And not all of them are going to be able to get it to the level Google got to TPUs actually being the one big threat to GPUs. But the demand is so big that these are still dropped in the buckets in terms of what the impact to NVIDIA's revenue. But what I'm most worried about is if someone in China figures out how to actually get the lithography right, build their own chips, crush TSMC on a multi-dimensional chip that can actually perform better than an NVIDIA chip, that would worry the crap out of me. And I think you're starting to see the crackdown now on exports and the export bans. You saw recently in Taiwan, there were several individuals that had been caught at TSMC for smuggling chips throughout. We've seen smuggling going on in Dubai. We've seen smuggling coming through Singapore. And so they're starting to crack down on those pretty hard.
Yeah. Hey, I was intrigued by a tweet last night, an X post from Nikesh Arora, the CEO of Palo Alto Networks. Did you come across this on NeoClouds?
I did see a little bit of that. Remind me
It was
what
kind
that
of an
is.
interest. I mean, the idea that he was basically saying that, and he did confirm. I mean, lower down, he said CoreWeave and Nebius, two of the biggest NeoClouds. He sort of suggested that they are doing more than just cloud services, and so they weren't really included in his analysis here. But broadly speaking, he suggested that the business of neoclouds, I mean, once the supply and demand economics equalize, that the valuations for these companies will drop considerably. Uh, what's your read on that? Do you agree with him? Because this is the big question, right? Well, I mean, 400% revenue growth, that's not sustainable, really.
I would liken this to the housing supply shortage that we have today. Like today, I can go to a large builder. They can build, tract homes. They can build big ass apartments and condos, and it's like the same thing. But there's always going to be demand in these neoclouds for something that's an empty shell that I can build to my suit, so I can build a suit. Something that's actually turnkey, that's tuned for my industry, tuned for my performance requirements. Something that's actually beyond turnkey. I think all these things are going to happen. And so I think as the neoclouds continue to differentiate, you're looking at what CoreWeave and Nebius are doing in terms of getting down to the details. Like you can custom build something out of the box. And the fact that they're always going to have the latest chips, there is definitely still going to be a market for it. Now, is that at 400%? I don't know if it's going to be at
Yeah.
400%.
So in other words, you disagree with his thesis here that valuations will drop markedly.
I disagree only because we're seeing a very different kind of demand emerge as customers are actually buying things that wouldn't have seen possible before. Just like, for example, if you want 1 trillion parameters for 1/10 the cost on premises, you'd go to Samba Systems. And to be able to do that before, and that's air gap, that's protected. I mean, I would go there if I wanted to get to a value game and beyond, on premises. If I wanted the latest version of GPUs and was only going to use it for like a year or two, or I can use it for a short period of time, or I need to actually get a burst capacity, I'm going to CoreWeave or Nebius.
Right, right. Last question for you. So Nvidia shares were higher on the results. If you look at the multiple, the multiple is sort of
Yes.
steadily declining. Do you see the multiple continuing to decline? What should we expect?
So we've got this theory, and we've been talking about this like at these Silicon Valley barbecues, right? This PE compression, the fact that Nvidia is trading at a multiple at 23, which is below the average of 24, right? Like that makes no freaking sense.
On earnings?
On earnings, yeah,
Yeah.
price to earnings is ridiculous on those ratios. They got PE compression. They were at 45 at one point, and we all thought that was high, but they should be in the 30s. And so I think the rationale and what's really going on here is because there's not a lot of volatility in the Nvidia stock. So no one's actually swing trading Nvidia. And so because of that, it's kind of steady. It's kind of holding where it's at. But if there were like one of those like a meme stock, I definitely think that they'd have a higher PE value. But there's no exciting news out of them, but that's great that there's no exciting news out of them because most people are holding these kind of like for retirement. These are institutional investors. They got a good group of those that aren't just going around and trying to like drive stock, play. They really are not trying to arbitrage the stock.
Right. Right. Great. Well, Ray, I want to thank you for coming on as always. That is Ray Wang, CEO of Constellation Research here on TITV. Salesforce shares jumped after its quarterly results last night. Revenue rose 11%, slower than the 13% from last quarter, but the company raised its revenue guidance for the full year, suggesting it could grow as much as 12% for the year. I want to bring on Laura Bratton, who authors our Applied AI newsletter, and Jackson Ader, Managing Director of Software Equity Research at KeyBanc Capital Markets. Welcome to the both of you. It's great to have you here.
Good to be here.
So, Jackson, I want to start with you because we spoke to you, I think, a couple weeks ago. I had asked you what to watch for with Salesforce results, and you had said, well, we're all going to be watching to see if AI can raise total revenue for the company. We've got this deceleration compared to last quarter. So, did it live up to your expectations? What do you think?
Yeah. It did. I mean, and I think, the stock's reaction today kind of, tells the story. What is important here, and I think what investors are taking away is that on an organic basis, the company still expects to accelerate its subscription revenue growth in the second half of their fiscal 2027 year. And even if that level is going from maybe 6.5 to 7 or 8%, it's not accelerating massively, but we're still on an acceleration train. That's what we heard last night. And so clearly we're getting a nice relief in shares after, a tough start to the year.
In other words, the deceleration from last quarter, it's less about that. It's more about what they're guiding to ahead.
That's right. And, they acquired Informatica, last year, and they've also made they're planning to make some acquisitions that are also being factored into guidance for the second half. But overall, organic results, both in the quarter, were slightly ahead, and organic results or organic expectations for the rest of the year are also moving up slightly. Again, I think the size of the reaction you could debate, but I mean, the company said what I think they needed to say last night.
Okay. Laura, what stood out to you from the call last night? I mean, the loudest part of the results was the Claude Force announcement. What was that? What stood out to you, or walk us through what you saw?
Yeah, I think the Cloudforce announcement was definitely important. It's just basically showing that Salesforce is going even deeper into its partnership with Anthropic, and they're making Salesforce more available in Claude. So you can do more with your Salesforce accounts natively from Claude than you could previously with this announcement. And we're going to find more about how Salesforce is going to monetize that partnership further at Dreamforce in September. I think the other things that stood out to me were just what Jackson was mentioning about organic revenue growth, because we've really seen Salesforce kind of rely on its acquisition of Informatica to boost revenue. And now we're seeing, its organic revenue not necessarily reaccelerate yet, but they're expecting it to. And I think early signs of that were just that they're seeing, contracts with existing customers expand. They said, net new AOV grew its fastest in 4 years. And I think Jackson could probably speak more to that. And then, the other thing that I thought was interesting was just Agentforce recurring revenue growing faster this quarter than the previous quarter.
And Jackson, I mean, just make clear for us, what is your understanding of the difference between Claude Force and Agent Force, how one fits into the other, how revenue is recorded between the two? Do we have any clarity here?
Not yet. Not yet. So the product isn't going to be launched. When we get to Dreamforce in September, we will probably have a better framework for what we're looking at here, right? Not just how are we going to make money from this, but also how is the integration actually going to work? What's interesting about CloudForce is that for the most part, existing or incumbent kind of large software companies have allowed the model developers to bring their models or their agents into the software environment. And this is really the first one that I can think of, or at least the first large company that I can think of that is saying, actually, we are going to allow the model company have its user interface, right? Claude from Anthropic, access all of the Salesforce data that it needs to, but the user themselves actually doesn't have to leave the Claude environment. So it's different from what we've heard from other software vendors, but we have no details. That's okay. This is more about the signal that Mark Benioff is saying. We are not afraid of disintermediation. We are not.
So I didn't realize that. So this means that you're accessing Salesforce through the Claude platform.
That's right.
So I mean, Laura, I mean, let's go back to the data sharing wars that we've written about at the information. I mean, does this say anything about those walls between enterprise software companies, model companies, those search companies? I mean, is this the first sign we've seen of those walls sort of breaking down? Because Salesforce they put up some of these walls earlier, right, with Slack.
Yes, with Slack, but I think we've seen they'd already started to reverse that. Particularly, something I'd written about earlier this year was at their developer conference, they announced Headless 360, which is, where they really started advertising like our user interface is dead and we're going to let use any AI agent that you want to access your Salesforce accounts. But it's clear that they're going all in on Anthropic in particular. Anthropic's models underlie Slackbot, which is their AI agent for Slack. And, now they have this deep partnership with Anthropic to make Salesforce particularly available through Claude. So like you're using Claude, not necessarily with a connector to call into your Salesforce data, but it's like your Salesforce account already is kind of like living within Claude. But obviously we need to wait and see more about that at Dreamforce. I think the really notable thing here is we still don't really know what the pricing is going to be for that. I've been trying for months to understand what Headless 360 pricing is going to be. And, my sources inside Salesforce still don't have a clear idea of what that's going to look like. And they admitted on the call that they're really trying to be flexible with customers about how they price and that they don't necessarily know what that's going to look like yet.
Jackson, are you hearing anything on pricing for Headless 360?
No, not yet. I think it's probably going to end up being some sort of, a platform fee and then a consumption type of model. That's just the way that a lot of these SaaS vendors are going. So, but nothing specific on Headless 360 versus competitors or other.
Right. I want to ask you a couple other questions here, Jackson. You pointed out in your note that MuleSoft and Tableau, those business lines are now, they're contracting, which is surprising. What's behind that? What did you make of that?
Yeah, it's tough. I mean, both of those businesses have some aspect of upfront revenue, and so if bookings are a little light, it can make the growth rates. It shows up right away in some of the growth rates. Tableau, I think what's happening is, what is AI really good at? One of those things is data visualization, and data analysis and dashboarding. That's tough. For the kind of the core use case of Tableau. MuleSoft, I don't know. I mean, I think of MuleSoft as the kind of the ultimate API gateway and the API company, and it seems like APIs are extremely important these days. I cover a couple of other companies that offer API security, and API security seems to be doing really well. So it's just, I think, a little bit of a deprioritization maybe on MuleSoft, or maybe that that technology is that there are next generation tools that are eating into MuleSoft. But Tableau is just, I mean, it's right in the crosshairs of what AI is pretty good at early on here.
Right, right. Laura, going back to the pricing point, so pricing was another thing that I know you've been you focused on last night with the earnings call. Um, so they seem to be taking after a Palantir model here a little bit in terms of outcome-based pricing, right? Can you explain how that works and, I mean, why we should believe that that will raise overall revenue instead of walking away from seat-based or even usage-based revenue?
Yeah, to me, this was the most important and interesting part of the earnings call was Mark Benioff sort of laying out the future of how he sees enterprise software pricing, because with the sort of disruption that investors have feared AI will cause to the software industry, software companies have begun shifting how they charge their customers. So they're worried that, if there's not as many customers using their software and instead it's just a few AI agents, they're not going to get as much of that seat-based revenue. And also, it's expensive to provide AI tools to customers. So, doing seat-based pricing might not make as much sense as, say, usage-based pricing. But what was really interesting is that Mark Benioff was very clear in that, he wants to do this kind of outcome-based pricing that's not just, oh, you completed this business task and therefore we're going to charge you this amount of money, which is already complicated. He's interested in doing the kind of outcome-based pricing that ties your price of the software to your revenue generated or cost saved. So that would be like, our software saved you 20% on cost this quarter, and so we're going to charge you this fee. Or you generated this much in revenue, and we're going to charge you, you know, this other fee. Anyway, so this is kind of how Palantir does pricing, at least for some of their contracts.
Right.
And Salesforce was clear that they're not necessarily going to use that pricing across the board, but they were pretty clear that, we think we
This
can
is the
command some
future.
aggressive prices. Yeah,
Yeah.
the aggressive prices. And so I think that that's really up for debate because already you hear Palantir customers say, this software is really, really expensive and we don't like how expensive it is, but we like Palantir software, so we're going to keep paying for it. I don't know if you're going to see that same stickiness with Salesforce.
Right, right. Jackson, I before we let you go, I want to ask you a little bit about the bigger picture here. So, I mean, Salesforce shares are up. ServiceNow shares are also jumping quite a bit this morning. Looks like a lot of software stocks are up. So, what? Suddenly, the SaaS apocalypse is not not as bad as we thought. What's the reason here?
Yeah, I mean, if you listen to some of these CEOs, it's over, right? But at the same time, it's been over for 12 months,
Yeah.
right? Depending on who you
But
listen
today
to.
specifically, I mean,
Right.
I mean, is it just a read through from the Salesforce results, or what do you
I
think?
think honestly, I think it's a sure. I mean, we can't ignore the fact that that Salesforce was strong, and that a couple of other companies in security software were also really strong. So it's kind of lifting the entire sector a little bit. But I think it's probably a confluence of things. One is certainly that multiples imply some level of future growth, obviously, right? Like that's what the multiple is, shorthand for your discounted cash flows of the future. And multiples in software imply really low and in some cases negative free cash flow growth into perpetuity. And I think investors and managers and these vendors are we're all kind of coming around to the idea that things are going to be more durable, right? And we are not going away. We're not seeing free cash flow declines. We're settling out at a lower growth rate, definitely, than we were before. And estimates have started to come down, but it's not the apocalyptic level that we were expecting. And so that's why you see ServiceNow or SAP and now Salesforce come out with fine but not stellar results, but see really outsized reactions because it's like, okay, a little bit of a sigh of relief here.
Right. And let me ask you this. I mean, the endorsement from Anthropic, I mean, Dario was on CNBC, talking about how much Anthropic uses Salesforce.
Yeah.
Is that a layer to this at all, of bringing endorsement of these enterprise software companies?
Maybe I don't know if it's necessarily any customer is certainly going to be positive and
Yeah.
be an endorsement. I don't think so. I think that's just someone who has a vested interest in this partnership going well.
Right.
Probably
Yeah.
being
Laura, any thoughts from your end on the rest of the sector? What Salesforce tells us?
I think that it's like Jackson was saying, just an indicator that software is not dead.
Right.
Another
Right.
indicator that we needed. Yeah.
Great. Well, I want to thank you both for coming on. That is Laura Bratton, author of our Applied AI newsletter, and Jackson Ader from KeyBanc Capital Markets here on TITV. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, on our YouTube channel, or wherever you get your podcasts. Make sure to follow us on social media, on X, on Instagram, on TikTok, and on LinkedIn. I am already excited for our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.